Okay, peeps, welcome back. So today we're going to be talking about how to fully diversify YieldMax ETFs for stability, income, and growth. Let's get it. So the purpose of this video is basically to address the concern that a lot of people have in terms of the YieldMax ETFs losing their value. Again, you guys got to understand the market's kind of the entire market, not just the YieldMax ETFs, have been getting beat down over the last 3 months. So it's not really surprising to see some of the price depreciation. Um, you know, the underlying equities or stocks or ETFs kind of getting beat down with the entire market. Plus, these yield max ETFs are paying a dividend on top of that. Kind of has a negative effect on the price. Once again, we want to see the price go up while paying the passive income and dividends. So, preferably the price moving up higher in terms of dollar and cents amounts than what the actual dividend payment is on a monthly basis would equal the share price increasing over time. But for those of you who are concerned about that, we'll talk about how to diversify that in this video. So, okay, so here's the general idea. This is of course a hypothetical. Okay, let's say that I was to, instead of investing in 10 of the yield max ETFs, let's say I have 7 yield max ETFs, both the Defiance ETFs and the Clip ETF, which equals a total of 10. Let's say instead of doing that, I take some of those dividends from those initial 10 investments, I move them over to slightly lower yielding dividend monthly paying income stocks. And then once I have enough passive income coming in from that, I move some of those funds over into 10 dividend growth stocks based on sector diversification. And I'll get into that in a minute. So this would be the general idea on how to diversify your portfolio. But for the diversification piece, or basically to hedge against the possibility of any downtrending markets having kind of a negative effect on these really super high yielding ETFs, this is how I would go about doing it. You guys can feel free to do what you want to, but this is, again, an idea that we're sharing with you. So the first thing that I want to address is simply by having exposure to, let's say, a total of 10 of these. Okay, so you have 7 yield max ETFs. You have the Clip Crane Shares ETF, and you also have the 2 Defiance ETFs. Just by investing in those 10 alone, you're getting diversification. Here's why I say this. Let's say that you owned, I don't know, these. We'll go with basically the top 6 plus Coney. All right. So with Tesla, you're getting exposure to Tesla, which in itself it's a mega cap company, but it does things like autonomous vehicles, electric vehicles, robots, AI, stuff like that. OARC is an ETF that invests in future innovative tech companies. Okay, they do have a large position in both Coinbase and Tesla. Last time I checked, or not Tesla, I mean Tesla. So you would be getting double exposure on that front. But this is based on an ETF which has a number of different positions in it, not just one individual stock like Tesla. And then you have Apple, which is basically your iPhones and maybe like some sort of virtual reality type of glasses and other stuff that they may have that people can use, like the Apple iMacs and iPads and stuff like that. Okay, so that's these 3 by themselves are diversification among tech. And then you got NVIDIA, which is basically AI chips. Amazon would be like your Amazon Prime delivery services. You got the AWS services, which is like web-based services, and people can do FBA businesses through Amazon. And you got things like the Amazon Alexa robot. There's a lot of diversification just by owning Amazon itself. And this is basically the dividend yield versions of that. Facebook or Meta, that was based on the metaverse, and you also have things like social media and the Facebook marketplace. So there's a lot there in those. So if you own just those 6, you're basically getting pretty much all of tech right there. Throw Coney in the mix, now you have exposure to crypto and Coinbase, and you're also getting a fat, juicy dividend yield on top of that. So you have diversification just by owning multiple of these yield max ETFs. But if you wanted to own these other 3, you diversify further. So by owning both, we'll just say triple QY and JEPY, since the Russell version hasn't paid a dividend yet, you're getting exposure to the NASDAQ 100 and the S&P 500 in correlation with the options market. and you're getting passive income on top of that. So this tracks the underlying indexes. That by itself gives you diversification to the overall markets. And then you also have basically the China internet sector here, which is pretty much what Clip is. It's based on the China mega cap tech companies over there in China. So you're getting, not only are you getting diversification just between these 10 in terms of the different sectors and companies you're getting diversification to, but you're getting individual stocks, tech exposure, crypto exposure. You're getting actual United States index exposures, and you're getting exposure to China overseas. So you're getting exposure to multiple markets, multiple stocks, and multiple different countries. However, if you wanted to take that even further and say, well, that's not good enough for me, so I want to make sure that my money's really safe, so I want to have it spread out even further, well, basically, you guys could take 10 of these dividend income stocks that we look at that yield roughly between, I think, like 5 to 17, 18%, something like that. And you could invest in these. Or again, you could pick any number with all of these. You don't have to do 10 dividend growth, 10 dividend income, and 10 of the high yielding ETFs. You could do like 5, 5, and 5. It's all based on personal preference. But we go down a little bit further here down the list. You guys can see some of our picks. So we have Beto, which we don't currently own because we think there's, again, it does give passive income, but we think we would be better in LTCN over the short to midterm. So we'll take a look at some of these other ones. You have things like ACP, which, it doesn't really look very appealing at first glance, but you guys got to understand some of these dividend income stocks have been beat down over the years. You guys can see during the pandemic lows, pretty much hit the price targets we're at now, and then it zoomed all the way up here to $12.50, and now we're back down here because of the Fed funds rate going up. But so let's take a look at ACP's dividend payout. So you get 10 cents a share with this. It's not bad. It's not like 50, 60, 70 cents a share, but it's something, It's basically we take a look at the most recent price. It's a $6 stock. So if you wanted to own 100 shares of these, you'd be talking about like $600. That's not really that much. So 100 shares, which is about $600, which get you about another $10 a month of passive income. Okay, we'll take a look at another example. BSTZ. This is actually a BlackRock ETF. So as you guys know, BlackRock, we've been talking about this in crypto, is the biggest asset manager in the world. They have $10 trillion under management in assets, and they have filed for a spot Bitcoin ETF. But as you guys can see, during the pandemic lows, once again, we were sitting roughly about the prices we're at now. But at the peak, we were at $43. So, there's a lot of upside potential in these, even though they are technically just dividend income stocks. So we'll take a look at the BSTZ dividend history. You guys can see here currently the dividend yield is 8%. It actually used to be higher than that, but they've had some, obviously you guys can see dividend cuts here. But that's understandable because the Fed's kind of crunching the markets by making stuff more expensive to borrow by increasing interest rates. So that's understandable why that's the case. But as you guys can see here, the dividend used to be 19 cents and then went to 16, 10, 10, and so on, so on. You guys can kind of see the dividend history here. Not only have they had cuts, but they've also had raises as well. So we're basically back at the pandemic levels in terms of passive income. And then you saw that it went up, and then it went up again. So there is potential for it to go back up. So if you wanted to buy 100 shares, you're talking about $1,500 here. 100 shares would get you roughly about the same as ACP, so about $10 a month, with a pretty large upside potential in terms of price appreciation. As you can see, the huge difference here. Ellington Financial is another good one. This one's actually held a little bit more stable than the previous two. You guys can see we're way higher than the pandemic lows. You would have made bank on this one if you had bought at the bottom and sold at the top. You would have made like almost a 7x on your money, so that's kind of crazy. But you can see the median price right now is roughly somewhere between, I'd say, roughly about 15 to 19 bucks. So we're actually cheap in terms of price right now. It's at $12.80 a share. So if we take a look at that, type in EFC, So you're getting 15 cents a share. This is slightly higher yields, about 14%. So you would have to invest roughly about just shy of $1,300 to get 100 shares, but 100 shares would basically give you about $15 a month of passive income. And again, you can go as high as you want to with these. If you want to own 500 shares, 1,000 shares, it's completely up to you and what your risk tolerance is, how much you're willing to invest and stuff like that. But there's a lot of potential here to diversify, increase your passive income. And these are obviously, as you guys can see, these are more stable dividend pairs. Like ACP is very stable, EFC is very stable, BSTZ is kind of an anomaly, but 10 of the dividend stocks that we're actually invested into, dividend income stocks, is ACP, which is 10 cents a share. BSTZ is currently 10 cents a share. It could go up in the future. It's possible to go back up to 19 cents. EFC is 15 cents a share. GOD is 10 cents a share. HRZN, 11 cents. OPP, I think, is just a little over 10 cents a share. So with this one, you'd only have to put in like about $800 to get $10 a month. RIV is about just under 13 cents a share. So 100 shares, you'd be looking at $13 a month. And that's about $1,000 invested. PDI is 22 cents a month. So if you had 100 shares of PDI, would cost you about $1,700 to get. But at the same time, because it pays 22 cents a share, you would get about $22 a month. So that's not bad. And we'll actually show you guys that here in terms of the payout. You guys can see that this thing has paid 22 cents for a very, very, very long time. It's been a really long time that it's been paying this amount out. So very stable, very steady income. So that's 1, 2, 3, 4, 5, 6, 7, 8. PFLT is another good one, just over 10 cents. And I would say JEPI, but I'm actually not invested in that anymore. We're not invested in NUSI either. QYLD, RYLD, we do have those. So that's a potential. It's basically roughly about 16, 17 cents a share on these. So I'd say about a 10% yield roughly on these two. So that could be 10 dividend income stocks you could diversify into. Basically, pour some of the YieldMax ETF dividends into these to get more stable income. And then once you're satisfied with those numbers, you can move over to the dividend growth stocks, which we're going to show you here. So this is a list of the best dividend growth stocks by sector. Now, these may not necessarily be dividend growth stocks. You'll have to look these up individually. It does only say dividend stocks, but I know for a fact some of these are dividend growth stocks, like this one is PPG, Qualcomm is, Verizon is, Broadcom, Cincinnati Financial is, Archer Daniels, Cisco. These two we actually used to own. We used to own Comcast. You got Brunswick there. That's interesting. We're big fans of bowling, so it's interesting to know that Brunswick actually has a dividend-paying stock. And then you got some of these other sectors. So you got Emerson Electric. We used to own that one. Union Pacific, FedEx, Norfolk. Let's see what else. National Fuel Gas. That's a really good one. You guys can see 53 years of dividend growth here. So it does say that they all have years of dividend growth, or almost all of them, I should say. So this is something to look into. And let's just say you own one of these out of each sector, okay? So the ideal way to go about this to get paid as often as possible and get sector diversification and also have 10, assuming you wanted one from each sector, dividend growth stocks, is to pick one from each sector, like I would say like 2 or 3 that pay in January, April, July, and so on, 2 or 3 that pay in February, May, August, and so on, 2 or 3 that pay in March, June, September, December, and 2 or 3 that pay in April, July, October, and December, or as close to that as you can get it. So that way you get the 10 dividend growth stocks, you get the diversification among the sectors, you have 10 stocks in high yielding dividend stocks, 10 dividend income stocks, and 10 dividend growth stocks, and you're still getting paid once a month from all these dividend growth stocks. So that gives you like absolute maximum payouts per month, per week, so on, stuff like that. But on top of that, you're also getting, like, with the minimal amount of positions held, the maximum diversification and exposure to all these different sectors and markets. So I'll leave this in the description for you guys down below. This is every current sector within, I believe this is the S&P 500's dividend sectors. I could be wrong about that, but that's something you guys will have to check in your own time. But there are 10 different sectors, and you guys can see that there's quite a big list here. I'm sure this is not exclusive. There's probably um, more different dividend growth stocks you guys could pick out of these, but this is obviously, according to the website, the best in each sector. So anyways, hope this helps you guys out somehow with diversification. And if you guys are worried about the YieldMax ETFs going to zero and stuff like that, which again I highly doubt is going to be the case, this would be how to fully diversify income across multiple different asset classes: dividend income, dividend growth, and high yielding dividend income or options ETFs. So hope you all enjoyed this content. Please like, comment, and subscribe, and we will see y'all later. Peace.